What is the definition of relevance under the IFRS conceptual framework? We'll start with the fundamental qualitative characteristics of relevance, not because it's more important than representational faithfulness, but because I happen to mention it first. Relevance means that information must have the capacity to impact decision-making for the external stakeholders. It must have the capacity to change a stakeholder's mind. Information is considered relevant if A. It has predictive value, meaning it helps stakeholders to make predictions about the future. And B. Feedback or confirmatory value, meaning it helps stakeholders to confirm or correct their previous expectation or predictions. Let's do an example to clarify exactly what relevant information means for decision makers. Say I own a company which I plan to hand down to my children, and I hope they will hand it down to their children. The company owns and uses a property in downtown Toronto, which is fully paid for, and the company plans to use it, well, forever to generate revenue. You're an investor, and your focus is to earn dividends. You are trying to decide whether to continue to hold the shares of Grec Corporation or to sell them. Is the market value of the downtown property relevant to your decision making? Remember, you're trying to decide whether to continue to hold the shares or sell them. And the answer would be no. The market value of the downtown property is not relevant to you because knowing the market value will not change your mind about whether to continue to hold the shares or not. Information about past dividend payments and the company's performance, their income over time, that's relevant information that will help you to make an informed decision because it will help you to predict what future dividend payments may be. Notice that information about the market value of the property is irrelevant because of your objective, wanting dividends now and in the future. Selling the property at market value won't make that happen, but using the property to generate revenue will. So the information about market value is irrelevant for your decision because of your objective. So, relevance sounds pretty easy to quantify, and yet it actually is pretty hard to pin down. That's because different stakeholders have different objectives and therefore different informational needs. What might be relevant information to one stakeholder will be irrelevant information to another. Let's use the same company but a different stakeholder to demonstrate this. Say you're now the bank. The same company, Grec Corporation, has come to you to borrow money so that they can expand. They want to use the downtown Toronto property as collateral for a loan. Just so you know, collateral is something that is pledged as security for repayment. Assets that are used for collateral will be forfeited or given up if the company defaults on their loan payments. Now, is the market value of the downtown property relevant to the bank's decision making? Absolutely yes. Information about the market value of the downtown property will be used by the bank to not only secure the loan, but determine the amount of the loan and potentially the interest rate. The market value of the property is relevant to the bank's decision making because of their objective, determining whether they want to lend money to the company or not. So we have one company, but two stakeholders with different objectives and different informational needs. You can see why relevance, information that has predictive and/or feedback value, is critical to the stakeholders' decision making. However, you can also see why relevance is difficult to pin down in general purpose financial statements because they have to meet the needs of very different stakeholders. Relevance.